2025 is being known as many things, but one of them is unfortunately geopolitical risk. In today's video, we need to take a look at exactly what happens to markets around the world as these types of conflicts take place. And if things get worse before they get better, could we see even more money flow into gold and other alternative assets? In today's video, we break down the key levels for the S&P 500 for the week ahead, the market structure of the last 50 years and what that can tell us, the huge moves in oil and Wall Street's biggest bets yet, and of course, the huge breakout in alternatives. That and more coming up in today's special weekend show. Guys, there's a lot to discuss, and there are some absolutely bonkers dark pools starting to appear on the markets. You know what that means? It means Wall Street is up to something big. Let's take a look right now together. We'll see you soon. Well, welcome back everybody to a special weekend edition of The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the big data, and of course the key flows, including what's happened over the last 50 years and what history can tell us about the current escalation in the Middle East and how this may play out in markets. There's a lot to go into, but just before we jump into that one, a quick reminder, if you're from Melbourne, Australia, make sure to click in the links in the description down below and sign up for our free trading event live here in Australia on the 2nd of July. It's going to be a great one. We share some stuff there that we don't even on the channel, and I think you will want to get there if you can. Let's start off though with the show here in terms of oil moves. Now, we obviously know that this is continuing over the weekend and we are in day 3 of this unfortunate event. But what tends to happen when we see these events occur? Well, we see an immediate spike in oil. This time, of course, we saw no different, and actually the markets were moving before this event even occurred, as we'll talk about soon. Wall Street clearly was moving flows into this well before everything happened. And then, of course, they fade within days and generally cooler heads prevail. But will that be the same this time? Well, obviously this is just a market observation, but let's take a look at how it affects America and therefore how it affects the main market that a lot of you guys are trading. So market reactions to invasions and wars. Now, we've seen this one before, of course. We've used a similar chart back in 2022 to talk about how we may have been seeing a buy kind of the invasion or buy the event style risk. And you can see here that yes, that is what has occurred many times in the past. But as you'll kind of find out, we'll break it down in a moment, this one might be a little bit different, and we'll explain that in a moment. Oil's bullish biases increase. There's no doubt that there were huge amounts of calls coming in over the last couple of weeks and months, in fact. And notice this, we are now at peaks not seen since 2024 at one period and 2022 when we saw everybody turn bullish on oil, and obviously it went absolutely ballistic during that time. Could this cause a massive short squeeze? Well, it already has had that effect, and we're starting to see that play out in extreme volatility on the market. And I would not expect Monday, Tuesday, Wednesday this week to be any less in terms of extreme volatility. Energy stocks, where are they going? Well, we just had Monday to Thursday, remember this is before the conflict occurred, energy stocks gain over 3.9%. The best sector by far in the market, along with healthcare, which is of course a defensive. And you may notice there were a couple of defensives starting to play out here, including utilities as well. Now on Friday, there was really only one section of the market that was basically up, which was energy, and the rest were down further, but by the end of the session, they've recovered quite a lot. So as we kind of suspected, and we posted over on X, links in the description down below, the markets did rally initially. Obviously, then we saw some retaliation. They dropped off into the risk on, kind of the week. So that means the weekend risk that was there from, leverage traders. But we did have a 5-day movement of 5.62% on energy and a 1.74%. So defensives were up, and of course, markets were just all about energy for that particular day. Now, you might be thinking, well, we're hearing news of potentially, something with Iran potentially closing off shipping the energy of the world, so the oil, and you might think, well, this is going to heavily affect the US. Well, generally speaking, not really. Since 2024-25, you can see here a huge amount of that oil is actually flowing to China. It is not necessarily flowing to the US. And in fact, 85% of all Iran's oil exports go to China. So this is not going to affect necessarily as much. the North American oil in terms of causing these kind of supply-demand gluts and problems there in terms of the supply network, but it still will spike the contracts. You can see here big oil surges, if they sustain, tend to cause big problems with markets. In fact, the last two times oil's prices topped and then we saw these massive movements in oil, we actually saw, of course, a declining market. This was kind of what also tripped some of these bigger pullbacks that occur. And with an exhausted big V shape, you can see here the V when you draw that on the charts, could we be heading for another one of those? I'm going to ask you guys in a poll after this video to see what you think. Obviously, we'll give you the information both ways in this video and we'll find out what you guys think. And then I look forward to our Monday open so we can kind of figure out what you're thinking and also what the stats actually say. So you might say, well, okay, what's happened in the past? We've seen those kind of buy the dip style situations in the past, but have they all been like that? Have they ended up in a further drawdown? One of the comments that you mentioned over on X is, what about further details? What happens in terms of the maximum drawdown? Well, it turns out that in at least most recent kind of conflicts, we haven't seen that bigger drawdowns. In fact, as you can see here, the initial movements were barely down, as in we actually saw the market sell, they rallied, and then they kept rallying for a period of time. And then, of course, some of them did sell well later on. Now, I have no idea why this chart has the Brexit vote in it. A few of you guys probably saw that. I don't know why it's there, but I didn't know that was anything to do with these types of situations. But anyway, it is there. And you can see here that the last two, anyway, didn't actually cause further sell-offs. They caused buy the dip events, at least over the next kind of 20, 30 days. So where have the big trades been? Well, we always look towards Wall Street. We want to know where Wall Street are at. We want to know where the biggest traders are at. And somebody most likely took some profit on oil trades on the Friday move. And the reason we know that is one large trade came through USO, which most of you would know is the big oil fund in the markets, and it was a fairly large trade. So this is the largest trade we've seen since September 26th, 2024, and that was quite a while ago. And yeah, I would say being at these highs, it's probably a take profit target, betting on the fact that that was a short squeeze that occurred throughout the Friday session, and it may not be sustained. Let's go to the broader market for a moment here, and we'll circle back to what's going on. First up, dollar. The US dollar has absolutely tanked over the last week, and it's continued that selling off event. Now, you might think that not enough people are seeing the sell. It's definitely becoming a crowded trade. A lot of people are on the sell, but we still see technical analysis pointing towards more weakness than strength. Now, traditionally, when you've seen conflicts like this, people have gone to safe havens. And one of those safe havens has, of course, been the US dollar, and we've seen treasuries. But that may not be happening again. In fact, Goldman Sachs believes it's a paradigm shift. And as we've been talking about on this channel, gold has been one of our favorite geopolitical risk style trades. And the reason why is because, unfortunately, we seem to be living in a world that there are more conflicts happening. And if we look at history, this often does expand through even more countries traditionally as these types of things start appearing. So let's hope that doesn't happen. But in this case, it was kind of what we thought about 2.5 years ago when we started to talk about gold, central banks buying, and some of the charts you'll see soon. Now, let's circle back to the idea of what's going on with investors, because of course institutions have been behind the 8 ball with this market in terms of how it's been rallying here since the real lows there back in April. Now, of course, private clients, that is us, retail traders, we've been going ballistic. We've started to buy a little bit less, but we've been going absolutely ballistic buying the dip, and a lot of the biggest players in Wall Street haven't been buying enough. So they're actually behind, and they're going to be set to underperform. Now, it turns out that the reason why this is probably happening is that we are seeing kind of soft inflation reports, sure, but then we've got some trade tensions, we've got geopolitical risks, we've got fund flows, we've got weak fund flows, by the way, and all sorts of other things that are causing a lot of these funds to sit on the side and say, I can't trade based on the macro events, based on this other parameters. Now, retail traders, they tend to ignore that and just say, Fed will save us, buy the dip, it's all good, everything's going to go up. And again, similar to 2020, it looks like retail has been ahead of the curve so far. But you'll notice here, if you look at this chart, total money market funds, there's a lot of money on the sidelines. And when we showed this chart in our previous video, it may have looked to you like, wow, there is so much money on the sidelines. This is going to mean that huge amounts of money are going to come into the markets in the future. Well, just remember, yes, there's a lot of money in money managed funds, but realistically, it's quite low in proportion to the overall asset allocations. So yes, there's just even more money out there since the prints of 2020 and every other print that the central banks have done. And you can see here that equities are actually now their highest ever allocation, 53%. So we've never seen allocations like this. They've gone past the 2000 bubble. They've gone past any other period of time. So this basically means that more people are involved in the market. And you might say, well, debt's been going down, not like the other peaks. It's a different type of debt this time around, guys. It's just not showing up in this chart, but believe me, there is a ton of debt there in terms of leverage in these markets. US equity risk premium, therefore, which is a very important thing that we always look for on the channel, is starting to drop off again. And historically, when we've seen these types of things occur, we know that nobody believes that the market is risky. So basically, the market is just chasing returns, not pricing in risk, and people are still just churning out the bull rhetoric that everything's going to be all good, it's all going to be green, and that generally is the right move throughout history. But we are starting to get back down to these nasty levels of equity risk premium, and we've got to be very careful if we get into these negative twos in particular. So we will be tracking this throughout 2025. So you might ask, well, why is the market going up? Is it going up just because retail traders are buying it? Is it going up because people are getting squeezed?